welcome. You're watching Editor's Take on Moneycontrol. I'm Sakshi, Batra, and with me is Gaurav Choudhury. He's the Deputy Executive Editor of Moneycontrol, and we are here to discuss about the Q2 GDP data that has been released by the Central Statistics Office today. Thanks a lot, Gaurav, for joining in. Well, a 4.5% Q2 GDP number. Are you surprised with it, or were you expecting this kind of a number, and is it a cause of an alarm?
So these numbers were clearly on anticipated lines. If you go by the lead indicators and also the proxy indicators, all those were actually pointing towards some kind of a GDP growth numbers for Q2 around this figure, and it has come on those anticipated lines. There are clearly, the devil is always, as this is, always in the detail, and clearly there are worry lines hiding inside the national income accounts data. And just to put things in perspective, this is a 6-year low.
Right.
The last time we saw GDP growth actually fall below 5% was in the Jan-March quarter of 12-13, when real GDP growth actually grew 4.3%. Just for a bit of a background, it grew 5% then, and it was later revised to 4.3%.
Right.
But be that as it may, it is almost closer to that crawl. So it would not be surprising, it would not be incorrect to say that real GDP growth is actually crawling at 4.5%. Importantly, if you look at what is happening in the sectoral aspect of it, manufacturing growth in Q2 has contracted, minus 1%. And this contraction now has extended for the first 6 months of the current financial year.
Right.
So for the whole month as a whole, for the first 6 months as a whole, from April to September, manufacturing growth has actually contracted minus 0.2%. That's not good. That's not a good sign.
Yeah.
And indicators coming from the shop end data, from the shop end evidence, like people buying fewer cars or consumer durables like televisions and refrigerators, and output data relating to these, we're all showing towards this kind of thing, because manufacturing output accounts for about 75% of India's total industrial output.
Yeah.
However, the bigger problem here is on construction. And if you compare what happened in 2012-13 and what's happening now, that's a big commonality.
Yeah.
Construction sector in the Jan-March quarter of 12-13 actually grew about 4%. And now in this quarter, it's grown about 3.3%. So what does it mean? There is a complete compression of spending on construction projects, particularly roads, ports, and highways.
Right.
That needs to pick up. Unless that picks up, which has strong multiplier effects in spinning new jobs, in creating income, I don't think the revival can be accelerated. Even if there are various fiscal interventions that
absolutely.
take place.
So the two growth-oriented sectors, the manufacturing sector and the construction sector, they are both raising a cause of alarm right now here, especially manufacturing, which has actually degrown in Q2 as well. But how do you think markets will react on a day like today? We've already seen record high levels being touched back to back on 2 days in this week alone. Today there was profit booking, about 300 points loss on the Sensex. Going forward, do you think this kind of a number was already factored in the markets, or do you think it will fall more?
No, I think markets had already factored in. And please remember, this data, GDP data, comes out with a 2-month lag. So this data is up till September 30.
Okay.
Much has happened after that. So we have had the festival season, buying taking place during that. And there was some glimmer of hope in the month of October so far as vehicle sales are concerned.
Sure.
There were some positive signs, at least some green shoot in some segments of vehicles, but that has to sustain.
Yeah.
Also, there is some pickup that is noticeable in bank credit. And please remember that the Indian economy, unlike, say, the Chinese economy or the US economy, is essentially credit-driven, bank credit-driven.
Right.
It is not as much equity-driven as it is in other matured economies. So if growth has to take place, if revival has to take place, if investment has to take place, then companies will have to borrow more from banks. There is some evidence that bank credit is showing signs of picking up, but these are scattered signs yet.
Right.
So I think the market is aware of what is happening now, and market generally goes by the present and what it expects in the future rather than the past.
Right.
This GDP data is about the past so far as the market is concerned.
Right.
So I would not expect markets to react too much to this GDP data unless there are some external factors, or there are some factors which the market did not see and has come out in the national income accounts data, which looks very unlikely.
Absolutely. So the market will be forward looking and will not react too much on this data for sure. But apart from this, you did mention about how signs of pickup or the scattered signs of pickup were seen in the festival season months. So what is your outlook on the Q3 GDP figures, especially keeping in mind that there is another figure that we have got today, and that is the core sector data for the month of October, and that is shrank further to minus 5.8%.
Yeah, so core sector that we need to keep in mind is that output data, and it has got to do with production, not as much with sale. And I would assume that large part of that output contraction would have also been driven by inventory management requirements. And also, please remember that in the month of October, there were more holidays. So factories were shut in greater number of days in the month of October compared to, say, other months. That is why output have contracted. But output may have that may have driven down output in core sector. But having said that, minus 5-point contraction is a cause for worry. The government would like to believe that this would turn the corner very soon, say in November, because and particularly in December when construction activity starts picking pace. In October, we also need to keep in mind that construction activity actually could not take place in a pace it usually does this year in October, because monsoon retreated very late. In fact, monsoon retreated in some areas from only in the second week of October. So that would have affected cement production and coal production, etc., or steel production. In November, again, there was another problem because construction activity in large parts of North India were stopped because of rising pollution levels. I would expect that core sector growth for November to be on similar lines. But one would expect that construction activity will accelerate in December onwards. Because the pollution levels have come down considerably. Construction activity will take place, and that could lead to some degree of revival. But as I said, it's early days and the signs are very, very scattered.
Absolutely. I also wanted to ask you just that what does this indicate about the 4.5% growth for the full year growth? If we want to ask about Q2 FY20, already the RBI is going with a number of 6.1%. Do you think it will have to be slashed further now?
So it now clearly appears that we are staring at a real possibility of a sub 6% growth in 1920. And the government, while presenting the economic survey, had projected that India's GDP will grow about 7% in 1920. That looks clearly unachievable. If we were to grow at 7%, then Q3 and Q4 GDP will have to grow at 9% plus. That's completely ruled out. That clearly, it's almost, it's unimaginable that it will grow at given by the evidence that is coming out from all the indicators. So I would expect, when the RBI presents its policy in a few days from now, I would expect that the GDP projections will be cut. And that it will be cut is probably easier to say, but to what extent it will be cut is going to be very interesting.
The rate cut, you mean to say?
No, the projections. The other thing is that if it's cut considerably, and what is the accompanying commentary? What does the Monetary Policy Committee think about the prospects of the broader economy? That is going to be very keenly watched both by commentators, analysts, as well as potential investors.
But is the onus back on RBI to cut the interest rates further?
So the RBI probably is going to cut interest rates. There is no second way about it. But to what extent? Because interest rate cuts, RBI has cut 5 interest rates 5 times since February this year in as many policies. It can probably go for one more round of cut. I reckon it's not going to cut, the rate cuts are not going to continue beyond this policy. Because it's very close to the lowest level which we had seen in April 2009 when RBI had cut the repo rate to 4.75%. The repo rate now is about 5.15%.
Also, inflation is inching up,
that is, and interest rates are not leading to a higher investment and demand. So I think it has reached the limits.
Absolutely. Thanks a lot then, Gaurav, for sharing all those insights. Well, definitely a 4.5% growth in Q2 definitely indicates at a deepening slowdown that we are seeing at the moment. What we'll really have to see is the steps taken by the government. How soon will they be really helping in the revival of growth from here on? Thanks a lot for joining us in this edition of Editor's Take, and do stay logged on to moneycontrol.com for more news and updates. Thanks for watching.